Is the data center build-out being funded by a private credit bubble? I wanted to find out for myself. So last night, I did a little bit of research into finding out, is there really a private credit bubble to begin with? And what exactly is the foundation of the funding for these data center projects? And is it really something that could cause the next great financial crisis? So first off, what exactly is private credit? Private credit is made up of money from three places. First off is insurance companies. Insurance companies are often looking to park money in investment vehicles, so they lend money to companies like Blackstone and Blue Owl Capital. The second source of income for private credit is pension funds. Pension funds for a lot of sovereign nations are included in the private credit lending that's being extended to data center projects. This includes the pension of firefighters, military personnel, public workers. All of their pensions have some level of exposure to data center project lending. The third source of funding is sovereign wealth funds. We're looking to gain international exposure to investment projects abroad. Basically, a private credit company like Blue Owl Capital will take the money from these three institutions and then provide financing for this data center project in exchange for some equity in the project. Okay, so how does private credit work in relation to data centers? If you're a hyperscaler like Meta or Amazon or Google, you have over $100 billion in backlog. The only way to realize this $100 billion in revenue is to build out data centers to satisfy that capacity and compute. However, spending $50 to $100 billion a year is not exactly very productive for your balance sheet, as it blows a hole in your company's free cash flow. And a lower free cash flow often results in a company's stock taking a hit. So basically, as a hyperscaler, you need the money that comes from providing the compute from the data centers, but you don't want to pay for the data centers right now all at once, or take on any significant loans that'll affect your company's balance sheet and scare off investors. In comes private credit. Say a data center costs $30 billion to build. Instead of spending $30 billion of your company's own balance sheet on this data center project, you can partner with a private credit company like Blue Owl Capital or Blackstone. They'll help you create what's known as an SPV, or special purpose vehicle. Essentially, it defines who the partners are in the project, who's providing equity. Meta's Hyperion data center that's being built out in Louisiana is one of the largest compute clusters in the world today. To fund this $27 billion data center build out, Meta and Blue Owl Capital formed an SPV, or a shell company, called the Baynet Investor, who basically takes on the debt load of this full data center build out onto their balance sheet, instead of Meta or Blackstone or Blue Owl taking on this debt onto their balance sheets. So the Baynet Investor owns the data center, its facilities, its assets, its debt, everything. And they're simply charging Meta a rent for every year of compute. So who exactly is the Baynet Investor? The Baynet Investor is made up of three private credit funds. The first being Blue Owl Capital, who owns about $7 billion of the $27 billion debt. The second, and by far the largest investor, is PIMCO, a private credit wing of Allianz, who owns $18 billion of the $27 billion debt. And the last lender is BlackRock, who owns $3 billion of the remaining debt. I personally feel with a company like BlackRock owning this debt, it's a little bit concerning to know that they're rolling off this debt into their own ETF products, like high-yield long-term loan ETFs. Clearly, this risk exposure from data centers is leaking out into all kinds of financial products, which really presents some concern as these data centers need to be built and executed to perfection in order for the loans to eventually pay themselves back and for the bubble not to burst. In relation specifically to the Hyperion 2 data center, I found some things that were also quite puzzling. Meta's only signed a 4-year lease for the Hyperion 2 data center with the option to extend. However, the debt associated to PIMCO and other stakeholders matures out from 2047 to 2049. For whatever reason, if Meta don't extend this contract, what happens to the debt in relation to the maturity, which goes out for the next 30 to 35 years? There's only a handful of customers that can afford the amount of compute being available in these data centers. What happens if all the hyperscalers pull back on compute capacity, and there's nobody to fill this expensive data center with expensive chips, energy, etc.? Those loans will come into question as the risk of insolvency will increase the longer they're unable to fill the data center with a new customer. For Meta, if they no longer need this compute by the time their contract ends, they can simply walk away from the table. However, the Baynet investor will be left with a data center, highly advanced chips, infrastructure, and all the debt burden to pay out for the next 30 to 35 years. Another suspicious aspect of data center funding is residual value guarantee. In a typical data center project, the lenders are often terrified that by the time the loan is due, the data center, with all of its infrastructure, highly specialized chips, and cooling, will all be worthless. To fix this, hyperscalers provide a legal guarantee to private credit lenders. They guarantee that at the end of the lease, the asset will be worth a specific predetermined price, or a residual value guarantee. Essentially, if the market value for data centers or assets drop below that residual value guarantee, the hyperscaler will be expected to compensate the private credit company based on the predetermined price of the residual value guarantee. In the case of Hyperion 2, to get lenders to provide such massive funding for the $27 billion data center buildout, Meta guaranteed the value of the building for the first 16 years of operation as their residual value guarantee. The interesting part is this depreciation liability doesn't show up on Meta's balance sheet, as it's a contingent liability. This is specifically risky because the debt has not been realized yet in the case that these data centers fail or depreciation is faster than expected. What I'm kind of gathering from this is that we won't know it's too late until it's too late. And not only will the data center trade be hit, but the parent companies and the hyperscalers who are signing the contracts for these data centers will also significantly feel the burden on their balance sheets. The last thing I found was maybe the most concerning. It's called chip debt. Basically, private credit companies are offering loans to neocloud players collateralized by NVIDIA chips. Yes, NVIDIA chips like H100s and Vera Rubins can now be collateralized to secure short-term loans from companies such as Goldman Sachs and Blackstone. Coreweave actually pioneered the chip equity model with Morgan Stanley and Blackstone when they were able to secure over $20 billion in loans collateralized by NVIDIA chips. These neocloud players are often able to secure funding for their GPUs, and then they're able to use those GPUs as collateral to secure funding from private credit companies for other things to build out, such as cooling, such as infrastructure, etc. There's funding to secure funding, and then collateral being generated on funding to secure more funding, and I think this kind of presents conditions for a bubble. In 2025, we saw Goldman Sachs reporting record amount of private credit lending and collateralized loans on NVIDIA chips. They've even fast-tracked approval to allow NVIDIA H100s to be used as collateral going forward in the future. It seems like they're all in on chip equity. Lenders typically advance 50 to 70% of the chip's value in financing. If a new NVIDIA Blackwell chip costs, say, $35,000, a private credit lender will offer you $20,000 against it. But what happens if the H100 becomes obsolete next year, or the Vera Rubin becomes obsolete because the Vera Feynman comes in? What exactly happens to the value of those collateralized loans? When the Blackwell chip hit full production in late 2025, the resale value of its predecessor, the NVIDIA Hopper, fell over 40% in value in 6 months' time. And the NVIDIA Hopper was often used as collateral for securing loans against data center projects. If the resale value of the H100 drops below the loan balance, we'll see margin calls happening, and the lenders will have to demand more cash as a result of the collateral being worth less. If the data center company doesn't have the cash to pay up for their margin call, we'll see private credit companies stuck with hundreds of H100s which they have no idea what to do with, and the bubble will most likely pop. Now, you might not be exposed to the data center trade, but I think one thing that's worth understanding is that all banks are exposed to the data center trade. You might bank with JP Morgan, but they'll provide financed funding to Goldman Sachs, for example. And that financed funding can be used in whatever way Goldman Sachs finds appropriate to deploy to projects, including data centers. In 2025, financed funding from banks to private credit companies grew almost 60%. So if the data center project fails, then the private credit company fails on its loans, and therefore the bank will also have exposure, most likely exposing the average consumer to the fallout of the data center build-out, if there ever is one. Full disclosure, I am invested in the data center trade myself. At the same time, I'm pretty surprised at the funding means and financing structures of some of these data center companies and neoclouds. I'm surprised that private credit has such loose regulations in terms of lending and collateralized loans. It gives me 2008 vibes, and I personally was much younger at that time and didn't really understand At the same time, what I'm learning is that nobody's safe. No bank, no person is safe. This is one of the largest infrastructure build-outs in all of human history, so a significant amount of liquidity and funding and long-term financing has been allocated to the data center build-out. At this point, we just gotta pray that the build-out works and the execution is on point on the data center trade. Anyways, I hope this was as informative for you as it was for me. As an investor, I have a much better idea of what exactly I'm invested in and the roller coaster that I am committed to. Take care, and I'll see you on the next deep dive.